Welcome to our final Taking Stock for 2024, where we stream you all things share market. I'm your host, Tim Lincoln, and joining me today is our head of Stock Doctor Research, Kien Trinh. And it's great to be here, Kien. How are you?
It's great to be here, Tim, and I can't believe how quickly the year has gone by, and so many things happening in the market this year, which we'll go through. But yeah, glad to be on board today with you, Tim.
Yeah, it's been a fascinating 12 months, hasn't it, Kien? But more on that in a moment. Great to be here with you too. But before we get started, all of the information we share today is a general nature and should not be construed as personal advice. And all of the data, performance metrics, and tables that we also share, all historical in nature and shouldn't be relied upon as a guide for future performance. As we touched on, Kien, it's been a really incredibly eventful year for the stock market in 2024 globally, really, not just here in Australia. And the euphoria around artificial intelligence gave the market a major boost earlier on in the year. And the momentum continued as the US began cutting interest rates, with investors becoming increasingly confident that the US and Australian markets were in for a softer landing than previously anticipated. Then came the Trump victory in the US elections, and as we've seen, has been a real positive for businesses generally. This all culminated too in the Australian market rising by about 13% for the year, for the calendar year that is, to date, and with the US and the S&P 500 indexes up around 23% over the same period. So against all odds, the market's had a terrific 2024.
Yeah, that's right, Tim. Incredible returns, and as you mentioned, against all odds, there were so many risks that could have affected investors emotionally, and leading you to be fearful of markets. But these risks, for instance, included the elevated market valuations. We also had the China property market downturn as well, sticky inflation, which kept on reoccurring. We had weak consumer spending, and of course, rising geopolitical risks in the Middle East as well. And only this week, we had further volatility in the market after the US Federal Reserve. They signaled fewer than expected interest rate cuts next year.
Mm. Yeah, there's been a lot of lessons to be learnt this year, and regardless of all of those risky, and it's really important to block out most of that macroeconomic noise and focus on, picking stocks from a bottom-up perspective and primarily the fundamentals of businesses and picking those great ones, and don't let the emotions get in the way, but rather concentrate on what you can control and understand. And that is the quality of stocks within your portfolios. By focusing on factors such as financial health, of course, golden rule number one, the foundation of all investment decisions, critical. Return on equity under our industrials model, or return on invested capital, or ROA for our infrastructure models and resource models, profit margins, earnings quality, free cash flow for income-seeking investors to get a good feel of sustainability of dividends. And therefore, if you combine those things and really respect those factors, it'll give you all the confidence in your own investments and able to endure these strange times. And to manage volatility and specific risks in your portfolio, it's important to maintain a well-diversified portfolio of, ideally at least 15 stocks to avoid over-concentration risks. Because it's impossible to get things right all the time, as statistically we've presented that over the year as well. But over the long term, a portfolio of high quality stocks give you a much better chance of outperforming.
Yeah, Tim, and this is reflected in the performance of our Star Growth Stocks portfolio compared to the All Odds Index, with the year-to-year comparison shown on screen here. You can see that over the last 30 years, our Star Growth stocks have only underperformed the market in 4 of those years. And that translates to a success rate of 87% and an average outperformance per year of 10%. And even for the year to date, our Star Growth stocks are up around 21% compared to the All Odds Index of around 13%, Tim.
Yeah, it really does confirm the importance of being laser focused on quality for the long term. And, they're really compelling statistics for our good old Star Growth stocks. And for income seeking investors, as it's been a good year too, with our Star income stocks rising around 10%. Although this was below the market's performance, which was driven predominantly by its overweight position in the banks and technology stocks that contain little yield. The higher for longer interest rate environment has also impacted many of the traditionally defensive income stocks, specifically within the REITs, utilities and infrastructure space. But over the long term, star income stocks have outperformed the market 9 out of the 13 years since we launched them. And obviously, the yield that they produce is a lot greater than the market average yield, which is probably the most important for income seeking investors. And speaking, as I touched on before, about infrastructure and utility stocks and REITs, this week the Australian Energy Regulator's draft decision not to grant regulated asset status to APA's Basslink electricity interconnector raises some questions, Kien. Can you explain what regulated assets are and what this means for the APA group?
Yeah, sure, Tim. Regulated assets are infrastructure assets with returns set by government approved frameworks, and that provides stable and predictable income. And APA Group, they sought this status for Basslink to reduce its earnings volatility as it currently relies on fluctuating spot market electricity prices. Without this regulated status, APA faces revenue unpredictability and may need to invest more capital into the asset, and that could impact their overall returns. On the positive side, though, APA did announce a potential deal with Tamboran Energy to build a pipeline, which could diversify its revenue base.
That's a real mix of risk and opportunity, isn't it, Kien? Wow. But despite the uncertainties, APA's 8.2% dividend yield remains attractive for income-focused investors. Now, Kien, let's pivot towards a number of star stock changes this week, starting with oil and gas producer Karoon Energy, ticker code KAR. Kien, why did we remove Karoon from our borderline star growth stock list?
Yeah, Karoon has undergone a few challenges over the last couple of months, and recently they face a production shutdown at its Borna oil field in Brazil due to anchor chain failures on its floating vessel. Now, this adds to ongoing reliability issues, including gas lift dehydration and leaks. As a result, they've lowered their financial year 24 production targets, and that raises concerns about their near-term growth profile.
So how critical is Borna to Karoon?
Well, Borna accounts for around 70% of Karoon's production, so it's quite large. And the reoccurring reliability issues, this creates uncertainty about how they're going to, or whether they're going to extend what they call their floating storage and offloading unit contract beyond 2026. And these risks and the poor growth outlook led to its removal from our borderline star growth stock universe.
Okay, it's a really good, clear example, isn't it, as to why operational stability is key. Really, really important. And speaking of challenges, Kien, let's touch on liquor and pubs business Endeavour Group, ticker code EDV. We've ceased coverage of Endeavour as a borderline star growth stock due to its ongoing financial deterioration. Financial health is still in place, but other growth metrics are certainly being challenged at the moment. I also noticed that the short interest, Kien, has risen above 5%.
Yeah, certainly raising red flags for us, Tim, and that's not surprising given the weakness in consumer spending. You've also got higher promotional activity that's going on, and also the recent Woolworths supply chain issues. That's weighed on the stock's earnings revisions, Tim, and that's combined with the inflationary margin pressures highlighted in the first quarter 25 result. The softer sales mix and declining operating margins, that means that they will unlikely meet their return on equity growth metrics anytime soon. And this is why we've removed them from our borderline star growth stock coverage.
Well, despite this, Kien, I'm a little surprised. I see that Charlie has retained Endeavour Group as a star income stock, even with those risks in place. He believes it still offers a sustainable gross dividend yield of around 6.8% on the back of strong free cash flow generation. Feel free to review the analyst commentary for all information where Charlie justifies retaining them as a star income stock. And now to Under the Microscope, Kien. And this week we're looking at something a bit more general rather than putting a a company under the microscope. We're going to take a look at the level of insolvencies and corporate failures over the last 12 months.
Yeah, Tim, with Australia's economy recording its weakest growth rate outside of the pandemic at 0.8% over the year. And then on top of that, you've got high cost pressures like wages, energy, rent, and interest rates. There has been a record number of insolvencies, according to ASIC, at 12,402 for the 2024 calendar year to date. And that represents a 47% rise from a year earlier.
Yeah, it's a bit of a concerning number, isn't it? But an indication of just how challenging it is out there in the business world at the moment. And within the ASX listed space, we recorded 24 corporate failures in 2024. And you can see this with the table on the screen right now. Among the notable collapses were Regional Express and Booktopia, both undone by financial instability.
Yeah, incredible with the another airline, Regional Express, as a perfect example, Tim. You know, we flagged that as financially unhealthy back in 2021 when it was trading at around $1.50. And despite the higher revenue and passenger numbers, its profitability suffered due to soaring debt levels, Tim, from just 4 million pre-COVID to around 368 million, before it collapsed. And this debt was the result of aggressive expansion, but also operating inefficiencies as well, compounded the financial strain, leaving Regional Express in a precarious position.
Mm. And operationally, Rex faced additional challenges, didn't they, Kien, as you started to touch on?
Mm.
Low load factors, in other words, how efficiently are the airlines filling up seats? Tough competition and pressure from private equity investors like PAG Group further destabilised the business. Ultimately, though, even the founder was ousted. Rex serves as a stark reminder that strong revenue growth alone isn't enough. Sustainable financial practices are essential. And then back to our point earlier around constructing portfolios of high quality business that leads to long-term outperformance. It's more important, I believe, is to avoid these potential failures as they are toxic to any portfolio.
Yeah, it's quite scary, Tim, because we've seen so much speculation, especially across this year, with many financially unhealthy stocks being bought up. And another one you mentioned earlier was Booktopia as well. It's a very similar story. As a leader in the online book retail space, it again pursued rapid growth, but also took on a lot of debt in the process, and that led to rising costs. They also, there were shrinking margins and increasing competition that really eroded their profitability metrics. And it's a cautionary tale about the dangers of scaling too quickly without maintaining that financial discipline.
Yeah, big lesson I learned from my father when we first started the business, 30 odd years ago, was to, really be careful of how much debt you do take on and growing too quickly. Try to do it as organically as possible, and that's what we've really done in our business. And I suppose why our gearing ratio within our financial health TLTAI plays such an important role to make sure companies aren't overstretching themselves. So these cases that we've just gone through, Kien, underscore the importance of financial health and making sure that profits are in place and they've got manageable levels of debt and strong cash flows. By prioritising these fundamentals, investors can avoid disasters like Rex and Booktopia while identifying opportunities in more sustainable businesses.
Yeah, definitely, Tim. It's a valuable lesson for investors. You've got very high growth stories with strong themes. It can be quite tempting, but growth is often unsustainable without that solid foundation.
And question of the week, Kien, and our final one for the year, and also our final taking stock for the year. A common question amongst our investors is what the outlook it looks like for the stock market in 2025 and how should they position their portfolios accordingly. Big question. Don't know what your answer is going to be, but I know what mine is. But perhaps I'll share that in a moment or two.
Yeah, I mean, the market is very unpredictable, isn't it, Tim? But yeah, some of the tools we use just to gauge market sentiment and earnings is is the recent earnings trends, and you can see the earnings revisions on Stock Doctor on individual stock basis. But the chart on screen actually compares the all odds index that's in blue with the 12-month forward EPS revisions, and notably we are seeing a reversal in the earnings trend. So it's starting to turn positive, and this could support share prices in 2025. And looking at the growth forecast for financial year 25 as well, we can see that earnings for the market this year are forecast to fall by about 5%. But most of this is driven by the resources. Earnings growth across the industrials, so outside those resources, are expected to be positive, while the banks are forecast to report quite flat growth for the year ahead.
And look at our mighty star stocks, Ken. Our star growth stocks are expected to generate a median growth rate or earnings growth rate of around 24% for the year. But that's all based on forecasts, analyst forecasts, and really a combination of those profits that are displayed under Golden Rule 3. So anything can happen, but they are a really strong guide, as we've seen in the past. But with that said, earnings trends can change, obviously, throughout the year. So we've got to keep a really close eye on those earnings revisions, of course, also under Golden Rule 3. Therefore, it's best to focus on portfolio risk management and concentrate on the fundamental factors of the stocks within your portfolio. Have a portfolio of at least 15 stocks, as I've mentioned throughout the last few years, and I'll reinforce that point today to avoid over-concentration risk and to ensure that we've got a nice diversified portfolio. And as we head into the next reporting season, Ken, which isn't far away, it's best to perform a clean out of your portfolio. Remove financially unhealthy stocks, ones that are just cluttering up your portfolio. That's general advice, of course, and any companies with elevated risks. You can also use Stock Doctor to set alerts such as negative earnings revisions, so you can closely monitor your portfolio over the next 12 months, especially in case that some of those profit forecasts start to change.
Yeah, and of course, you can also manage your portfolio through Stock Doctor's Portfolio Manager. So you can remove these stocks, you can rebalance your portfolio, and also you can run the Portfolio Optimizer to help generate new ideas for investment as well. So the reporting season in February will no doubt be quite volatile. So make sure your portfolio is in tip-top shape to weather this volatility.
And remember, my biggest lesson over the last 18 months is the importance of blocking out the noise and focusing on constructing a portfolio from a bottom-up quality perspective. And if volatility presents itself, well, you either ride through it, embrace it as opportunity, or use some of the technical indicators like SD30 TSR to help manage a portfolio around volatility if you're a little bit nervous. So, but the most important thing is to block out that noise and embrace all levels of opportunity that market presents. And again, if there's that little blip from time to time in regard to volatility, it's just very normal. But we know over the long term that the market is an incredibly resilient beast. And as you said before, Kien, totally unpredictable, but most of the time it heads northeast. So quality companies and just ride out the markets for the long term. So that's my message. And also my prediction for 2025 is that, again, it's just totally unpredictable. We haven't got a crystal ball. I tried to shore up portfolios 18 months ago by protecting clients' investments. Again, shouldn't have done it because we should have been blocking out the noise. And I thought the probability of a correction was high. But again, that unpredictability is that's become so evident over that massive lesson. So there we go. That's my big learning for 2024. And but we march into 2025 now, full of determination, full of endurance and good energy to make 2025 a fantastic year for, in particular, our members, and then secondly, our families and our business. All right, Kien, that's all we got time for. It's been great working with you in 2025. Thank you to your team and the entire Lincoln business for what we're most passionate about, delivering great product and service to our members. So well done for all of the contributions you've made. Been outstanding. Thank you.
Thanks, Tim, and it's always a pleasure working with you as well. It can be quite challenging at times, but over the year. These challenges is what we learn from, and also make us stronger as well. But as the year is coming to an end as well, we will be having our analysts available to help answer any questions you have, so on the stocks and the market during this holiday period. So don't feel like you're on your own here.
Mm. And we've got our Christmas sale on, so if any of our members have got family or friends out there who'd love to come on board, great offer this time of year to get into the market for 2025. Just get your family and friends to jump on our website, www.lincolnindicators.com.au, and you'll see on the homepage there under the Stock Doctor section the specials that are available, and they can join through that mechanism. And of course, you'll be rewarded with a referral as well. So that's available. But apart from that, that's all we've got time for today. Been a great year, as I've said. Have a great Christmas, everyone. Stay safe, stay healthy, and we'll see you all again in 2025. Take care. Goodbye for now.